Hello there and welcome to another video. And before I get into today's topic, if you have any questions, leave it in the comment section. If you want more videos like this, hit subscribe. Now, financial ratios or stock market related ratios is something we all look at when we're looking for new investments, and they usually include price to earnings ratio, which is PE ratio, PB ratio, which is price to book value, EPS, which is earnings per share, price to cash flow, etc, etc, etc. Right, now what do these ratios actually tell you? Well, in my opinion, they don't really tell you much. Now, of course, what they actually mean is how much money or how much assets or how much earnings does a company have per share. So in a way, it's trying to tell you how much you're getting for your money, how much bang for your buck. But you have to put them in context, and you have to really understand what they mean to you as an investor. Because someone might look at a company and say, right, it has really low ratios. That means it's a very cheap company, it's undervalued, and I should invest in it. Well, not necessarily. First of all, these ratios, if they are really low, usually means that investors are pessimistic about the company. Likewise, if they're really, really high, people have high expectations for the company, which is not necessarily bad. So if you're only looking for low ratios and getting the most for your money, you're basically a value investor. Now, there's nothing wrong with that, but don't think that these ratios tells you how good of a company it is or how good of an investment it is. It can do, however. Another thing you have to consider is these ratios vary a lot from industry to industry. A tech company will have the valuations and ratios of a tech company like Facebook or Google or Netflix is not going to look anything like an airliner like Southwest or Lufthansa or American Airlines. And airlines are not going to have the same ratios whatsoever as healthcare stocks and biotech stocks. These companies have crazy ratios, right? So they don't really tell you much unless you compare it to a lot of other companies and you know what you're looking for. If you're a value investor, you're looking for beat down companies, you're looking for beat down stocks that has low ratios. But simply going to Google Finance, searching up a company and looking at the ratio tells you exactly jack shit. Do not think that the ratios paint the whole picture. Things that are more important are financial ratios, economical ratios, like not ratios but numbers like margins, debt to equity, return on investment, return on equity, profit margin, net margin, free cash flow, stuff like this is a lot more important. So these numbers can tell you something about the company, and it can help you to time your investments. So if there's a company you really like and all of a sudden it goes down a lot, so it has really low numbers, that might mean it's a good opportunity to get invested. So take them with a grain of salt and really try to put them in context, and they can be a good tool in your investment toolbox. So if you want to know more about ratios or investing in general, you can visit investingforall.net.